Hello there. In this video I will be explaining the basics of finance that I believe everyone should know. I worked at one of the big 5 banks in Ontario, Canada for over 4 years, and I will be sharing everything I know with you here on this channel. The 3 things I will discuss today are how to invest, how to purchase a property, and the difference between TFSA account, RRSP account, and non-registered account and benefit of each one. Don't worry, I have got you covered. First thing we will discuss is how to start investing. There are 2 ways that you can start investing. First is through opening a mutual fund account, or opening a self-directed investment account. For both options you would have to go to the bank, book an appointment to open an account. When you invest in mutual funds, your money is invested into a lot of companies, not just one single company. There are 3 different types of mutual funds: low risk, medium risk, and high risk. Depending on how long you are planning to leave the funds in the account, that how you would choose what type of investment you would put your money into. Usually if you are planning to keep your money in the account from 3 to 5 years, then it is recommended to invest in a low-risk investment. 6 to 10 years medium risk is recommended, and 11 years and over high risk is recommended. If you are in your 20s and you start putting about $200 a month, you will be a millionaire when you retire. Assuming you will put it in a high-risk fund like NASDAQ 520 or US index fund. As an example, it is as simple as that. I will go into more details in a separate video. The younger you start, the more money you will have when you retire, just simply because of compound interest. Year over year the value increase. The bank charges a yearly fee of anywhere between 1% to 3%, just depending on which fund you invest in. Self-directed investment account is basically an account that you would manage yourself. You choose what type of investment you would like to invest into. You can invest in the similar types of investments like NASDAQ and US index fund, and pay less fees because you are doing it yourself and the bank is not helping you with it. You also have the option to invest into a single company, for example Tesla, which I'm pretty sure everyone is familiar with. The risk here is if you invest into one single company and that company goes out of business, you lose all your money. Keep that in mind. At the same time, you could make more money if you trade, meaning you buy it low and sell high. With a self-directed investment account you can also do option trading, which is a lot more complicated and more risky. If you want to know more about it, please let me know in the comments section below. If you want to invest your money and forget about it and have the bank do all the work, invest with the bank and put your money in a high-risk fund like NASDAQ and leave the money investment account. If you are the type of person that wants to learn more than just open a self-directed account and do your investments yourself, you will also save some money on the fees and have more options to open it under TFSA. Either way you do it, you will win in the long run, trust me. Now the difference and benefits of TFSA, RRSP, and non-registered accounts. Let's say you go to the bank and you ask to open a mutual fund account. The advisor will ask you if you wanted the account under TFSA, RRSP, or non-registered account. Let's say you open IT under TFSA, your initial investment. You will not pay any taxes on it. That is why there is a limit on how much you can add to the TFSA account. Now let's say you retire, you will be able to withdraw all the funds in your account without any tax obligations, all in cash without paying a penny to the government. RRSP account is a little bit more complicated. When you add money to the RRSP account, you get tax credit. For example, every $1,000 you add to the RRSP account, you will get $300 tax credit. So let's say you do your taxes at the end of the year and you have to pay $2,000. Because you have that $300 tax credit, you will have to pay only $1,700 back, which is good. However, now let's say you want to withdraw the money from your RRSP account. Depending on how much money you want to withdraw, you will have to pay between 10 to 30% of your money for taxes. And depending on your income that year, you might get some of that money back. Or you might have to pay more taxes. Because any money you take out from RRSP will be added on your income. Any profit you make will be added on your income and you will have to pay taxes on it. If you lose your investment or a portion of it, you can claim it as a loss when you do your taxes. And if you have to pay taxes that calendar year, you will pay less. There is no limit to how much you can add to the non-registered account. To end this video, I would say, if you start investing, open the account under TFSA. If your income is very high and want to avoid some taxes, put money in RRSP and leave IT there until you retire. Because you will pay no taxes if you take the minimum payments after you retire. Please like and subscribe, as it will mean a lot for me to keep posting. If I missed anything, please let me know in the comments section below. I will be more than happy to answer all your questions, as well as how I can improve my content. In the next video I will discuss all the mortgage information you need to know to purchase your first property.